NVIDIA stock is a stock we're very bullish on this channel, but just because we are bullish doesn't mean we ignore any of the bearish thoughts or bearish cases for NVIDIA. So in today's episode, what I want to do is take a closer look at the 3 biggest bearish cases that I keep hearing for this AI giant and just share my overall opinion. So let's take a closer look in today's episode.
I want to thank The Motley Fool for sponsoring this video, and check out fool.com/Jose for the 10 best stocks to buy now. With that link, you get a promotional offer for the subscription service. Now, let's continue with today's episode.
All right, so I want to start off with a few things. First, thank you all for all the birthday support in the last video. I really tried my best, and I spent a few hours responding to every comment, because if you're able to spend your time to kind of give me wish me a happy birthday, the least I can do is respond to every single one of you. So I just want to say thank you all for the huge support, and it meant a lot. The second thing is, I'm sorry I didn't release a video yesterday. I was just way too tired, but hopefully this video makes up for it. The final thing before we get started in today's episode is it's come to my attention that there are reports that many investors might be pronouncing Nvidia the wrong way. There are reports that some are pronouncing it Nvidia. Let me just say, I'm sorry if you've been watching other channels or other places where they've been pronouncing Nvidia the wrong way. I want to eliminate that kind of false information across the internet, and the only way I can do that is if you make sure to hit the subscribe button and the thumbs up, as we do not want to have those mistakes happening around Nvidia anymore. Now, all jokes aside, let's take a closer look at some of the bearish cases that are impacting Nvidia. And these, I want to say, earlier this week I posted X or tweet, whatever you want to call it, asking people to tell me what are some of the biggest bearish cases. And I've also gone around the internet to try to find what many are discussing. And the first thing, and I think this is rightfully true, there is this belief that a handful of companies make up most of the revenue and what happens when they stop, right? Everybody during earnings are worried about what Microsoft, what Amazon, what Google, what Meta are doing in forms of CapEx, because if that CapEx slows down, it's going to be game over for Nvidia. So while that is kind of true to some extent, it is important to understand how the revenue breakdown is. So in the most recent earnings, we did hear from the CFO of Nvidia that cloud server providers, which are your Amazon, your Google, your Oracle, your Microsoft, only provide 45% of data center revenue, and more than 50% stem from the consumer internet and enterprise companies. I want to say in those consumer internet, obviously you have those big companies like XAI most likely. You also have Meta in that group as well. So those are pretty much the big companies. But right now you can see that the cloud server providers are 45%. And in my opinion, it has many might come to the belief that the cloud server providers make up over 80 or 90% of total revenue. So while it's still pretty large, I do believe it's a lot smaller than what many expect. So obviously something to keep in mind out. The second thing though is, now that we are moving into this AI market, we are getting a diversified set of customers. So during this most recent earnings, the CFO also mentioned that they believe sovereign AI revenue will reach low double-digit billions this year. They also mentioned that the enterprise AI wave has started, and enterprises also drove sequential revenue growth in the quarter. So 2 main growth opportunities here outside of the cloud server providers. First, we're seeing that sovereign AI, so nations are really building up these AI infrastructures for their own national situation or solution, and sometimes it's not directly, we've heard it from, I believe, Nvidia's CEO in an interview, that it's not directly the nation. So it's not like I'm gonna build the United States government, I'm gonna build the Canadian government. Some of these governments, what they end up doing is they end up giving money or funding to other companies to build AI solutions for them. So you might see like a private or a public company adding maybe a cloud server provider, but those are being funded by the governments or that nation entity opposed to the overall company itself. The second thing we saw here is enterprise AI. So now we're seeing individual businesses also wanting to build up their own AI solution and not necessarily go into the cloud server providers. And that's a very big market opportunity, as enterprises are big nations, are big companies all over the world. And just to kind of reiterate this point, most recently, Dell Technologies reported earnings, I believe it was Thursday, and during their earnings call, the COO mentioned that encouragingly, they continue to see an increase in the number of enterprise customers buying AI solutions each quarter. Enterprises remain a significant opportunity for them as many are still in early stages of AI adoption. They are also excited about the emerging sovereign AI opportunity, which plays to their strength given their positions with governments around the world. So Dell Technologies, a whole different company outside of Nvidia, is seeing the same type of growth. They're seeing that enterprises are still in the early innings. So in a few quarters from now, the enterprise market could be a bigger opportunity. And very similar, they did mention the sovereign AI. Now, I also want to kind of take a closer look back at those big tech. So big tech is obviously spending a lot of money. And it's not going to stop anytime soon. And I personally believe that the answer is no, because if you stop investing right now, you're going to get trampled and beat by all your other competitors. The moment Google stops investing is the moment Amazon and all these players, Microsoft, are going to take clouding market share from Google. Is probably going to be the time where Microsoft might have the opportunity to take search market share from Google. So right now, if you want to be able to keep your market share in your clouding market or maybe in some of your core products, you're gonna want to keep investing in AI. I mean, if Google doesn't invest in AI solutions for their advertisement, Meta's gonna probably take a nice amount of market share. And the CEO of Google mentioned it pretty well. He mentions that he thinks one way to think about it when we go through a curve like this, and he's talking about the curve of innovation here in technology. The risk of underinvesting is dramatically greater than the risk of overinvesting for us here. Even if it turns out that they are overinvesting, which they believe they're not, these are infrastructures which are widely useful for us. So they have long useful lives and we can apply it across and we can work through that. But I think that not investing to be at the front here, I think definitely has much more significant downside. Having said that, we obsess around every dollar we put in. So the CEO of Google is saying, hey, look, we don't believe we're overinvesting, but in the worst case scenario that we are overinvesting, these GPUs and data center solutions that we're building, we can use them for a variety of solutions, not just AI. So we'll be A-okay. And these GPUs tend to have a very, very long lifetime. The more important thing is if we don't overinvest in this market, our competitors are going to, and they're gonna completely destroy us. So this is the mentality happening all around the world right now. And I believe it's gonna continue like this at least for the next year or more. Now, the final thing I also want to mention is many people just see kind of these AI solutions as AI, advertisement, and maybe the clouding market. But the CFO during the most recent earnings did also give us some great insight of where some of this money is coming from. Automotive, for example, will drive multi-billion-dollar revenue across on-prem and cloud consumption and will grow as next generation autonomous vehicle models require significantly more compute. So we can see that the automotive market is already a big use case for AI. They also mentioned another potential huge case. Healthcare is also on its way to being a multi-billion-dollar business as AI revolutionizes medical imaging, surgical robots, patient care, electronic health, recorded processing, and drug discovery. Now, before I take a closer look at point number 2 and number 3, I want to say thank you all for the support on the earnings semiconductor ebook. For those that are not familiar, I have this ebook which covers over 40 earnings right now that just came up. I have one more update. The great thing, if you purchase this book, you get all the updates for free. So I have one more updates with companies that are expected to release next week, but we already have companies like Nvidia, AMD, ASML, TSMC, and the list goes on and on. Over 40 companies, you'll get a lot of great insight. More importantly, if you use the code YouTube, you get $10 off. So I personally believe it's a lot of great value. You're going to learn a lot about the semiconductor market. Make sure to check it out at moresemiinvesting.com. All right, so now point number 2 that we're going to discuss is margins are contracting, right? And because of AI, Nvidia has grown their gross profit margins dramatically, as many would think. But I want to kind of fight that stock as well. So Nvidia's gross profit margins, if we look versus a quarter ago, did drop. So right now, gross profit margins are 75.15 for this most recent quarter. Last quarter, they were around 78. So many people are saying, hey, look, Jose, gross profit margins are dropping and they're going to drop back down to some crazy low values that Nvidia had in the past. Now, the second thing I want to say is, do you know what Nvidia's gross profit margins were before this AI craze? And we can see here 2022, 2021, before the over inventory correction that we saw between 2022 and 2023, gross profit margins were around high 60%. So it's not like this company's gross profit margins jumped dramatically, right? Obviously, 10 percentage points is a nice amount and a nice boost, but it's not like this company was fully crazed by this AI market. So it's obviously important to understand that if gross profit margins drop, that would be bad news for the overall stock. But even if they go back to their normals, it's not that scary in my opinion. I personally don't believe they're going to go back to their normals for a few reasons that I'll mention in a bit. But first, I want to showcase, look what was the 3-year median. It's not too crazy off from where they're at right now. Now, the other thing is many bearish case are saying that, look, gross profit margins are dropping. Luckily for us though, long-term investors already knew that this was going to happen. Last quarter, the CFO pretty much gave it to us. They mentioned that the first quarter, they had margin expansion and non-GAAP gross margins were roughly 79%. The main reason was because they had favorable component costs. And then they mentioned that for the rest of the year, they expect revenue to be in the mid 70%. For example, for quarter 2, they guided roughly 75.5%, which was exactly what we got. So it's not like this was new news. And last quarter, they did mention that for the full year, they expect gross margins to be in the mid 70% range. Now, with this downfall in gross margins, did the CFO change their mind? Nope, CFO mentions that for the full year, they still expect margins to be in the mid 70%. And for quarter 3, they expect gross margins to be roughly 75%. The main reason they mention is right now, they are seeing kind of with new products being released, those new products tend to have weaker margins. So, I mean, mid 70% is still pretty strong. I do believe we have peaked. But from that peak, it's nothing too scary in my opinion. The other thing I want to mention is Nvidia is growing in the software space, and the software space also tends to have higher margins. So as they are growing in those software space, I do believe the median of the margins is going to continue to grow. Again, I just want to finish off with the point that even the 3-year median wasn't that far off from where we're at right now. So many people have this thought process that because Nvidia is a semiconductor company, it's a hardware company, gross margins were probably around 50, maybe even 40%. But that wasn't the case. We can see 3-year median is closer to 65. So the final bearish point that I keep hearing is big tech designing their own chips, and it's game over for Nvidia because they're going to reduce their dependency of Nvidia's AI solutions. And a few meetings ago, the vice president of accelerated computing business answered this same question and kind of explained why this is not necessarily a big deal. So first, he does mention that in forms of AI solutions, the best architecture for you to do your inference solution is actually the one you trained on. I'm not necessarily an AI expert, and I wouldn't know if this is true or not, but we can hear from Ian Buck, the vice president, that he believes this is the case. The second thing he talks about is developing your own chip takes multi-billion dollars. And before we go on to the next point, I want to mention a little bit more about these chip designs that these companies are making. So the designs that these companies are making are called ASIC. So these are solutions that are really meant for one application. The bad thing about these use cases or these ASIC solutions is they're not programmable. Once you set them, they're only good for that one workload that you know you're familiar with. But if the market evolves and it uses another type of workload, another type of technology, then your chip pretty much becomes worthless unless you keep using that workload over and over again. So now that we know that, Ian mentioned that, look, the second thing is that The models are always evolving and changing over time. Think about it. You're going to invest 1 billion, 5 billion, 10 billion in the data infrastructure for inference or some other solutions. That asset needs to last you a long time, maybe 4 to 5 years. So that's where the great thing about GPUs are, right? Because GPUs, they are programmable. So if the models are evolving and there's new workloads, the GPU, while you're spending tens, 15 billions of dollars on them, they're going to be able to adapt. Unfortunately, that ASIC solution that you created and then you spend multi-billion dollars on doesn't have the guaranteed that it's going to adapt, and it might just become paperweight in the next few years. The other thing that he mentions is right now he believes that the Keplers and Voltas into data centers are now just starting to retire. You might be wondering, Jose, what the heck is a Volta? Those were the earlier versions of what we know now as the H100. The Voltas were released in 2017. We're right now in 2024. So the lifespan of these NVIDIA GPUs are actually pretty high. I don't think I can say the same about ASIC solutions. So what's important about these ASICs is not only that they are able to work on the models that are important today, but the ones that are going to be more important are the ones that show up tomorrow, after that, and after that. You know that you can make an investment and have that capability, that platform infrastructure that's going to continue to produce. So that's the benefit, the insurance you have when having NVIDIA GPUs is you know that that GPU is going to be very good for the next type of workload and the one after that. And finally, the execution there is very difficult. Tape outs to productions are very long, and they are longer than the innovation cycle of AI. If you're not a semiconductor manufacturing person, that might have gone a bit weird, but what he's mentioning is, hey, look, for you to design a chip takes multiple years. For then you to get a tape out, which is kind of like an engineering sample, takes a few years from that. Once you test everything out, fix everything out, and get it to production, it takes a long time, maybe 3 to 5 years. So within your 3 to 5 years that you're developing this chip, the overall workload that you were originally developing might have already become obsolete or is changing to something else. So that's why it's very important to have programmability, and that's something that NVIDIA's GPUs provide and not ASIC solutions. Now, Ian does mention if you have one model, if you have one device and you know that model is always going to stay in that one device, then it makes perfect sense. So there are solutions or reasonings for these big tech players to maybe design some ASIC solutions, but they're not going to completely replace NVIDIA. The final thing is NVIDIA is a platform business, right? And you have developers and software engineers developing apps and just libraries and solutions on the CUDA platform. And something like CUDA, which is used by various designers and developers, is always being updated and having the greatest and best AI solutions. So if you're designing an AI chip, but there's no developers, there's no libraries, there's no innovation, why are developers gonna waste their time? So when you talk about other types of chips or ASIC solutions, you have to convince the developer to say, hey, look, that's a good time for me to spend right now opposed to developing on CUDA or any other type of NVIDIA solutions, because I know NVIDIA is going to continue to accelerate the development of their software, of their hardware, and I know I'm going to have the best time doing it and the better chance of success. So just a quick breakdown, ASIC solutions are only great for one thing. NVIDIA solutions are great for multiple things. We have NVIDIA GPUs that are 7 years old that are just starting to get retired. The same can't be said about ASIC solutions. The fine thing, NVIDIA has created an ecosystem, a platform for developers, and is always accelerating and innovating, and developers are not going to want to leave that platform for something that they don't know is going to be used in the next few years from now. So those are my thoughts on this big tech designing their own chip and why I personally don't believe it's game over. I actually want to end this episode with just my final thoughts. I do believe it's important to have expectations. Just because I'm a bull for NVIDIA doesn't mean I'm a perma bull. I think the chances of seeing triple-digit year-over-year revenue growth are becoming very low, almost non-existent, but high double digits will be the new normal. I also don't see the stock growing as fast as it has in the past year, but I believe in the long term it will still outperform the S&P 500, it will still outperform the Qs, it will still outperform the semiconductor market, and that is why for me it's still my number one company. Finally, valuations are not that scary, but at these price points I personally wouldn't buy either a big or even a medium position. This obviously could be due to my cost basis bias. I got into Nvidia at very low prices. Forward 1 year PE ratio is 30. I believe the market gives us opportunity for better price jumps, but those are just my overall thoughts. Let me know what are your thoughts on the comments below. Regardless, this company is going to be my number one position for many more years. Take care, have a good day, and see you next time.